Hello and welcome to the investment review for May, looking back at the events of last month. After what feels like an incredibly long winter, at last the sun appears to be shining once more, and we can welcome the green shoots of another spring and all the hope that comes with it for better times ahead. Giving a quick look at market commentary, during the past year there have been two main areas of concern to the global economy. The first is the US fiscal cliff, and the possible failure of the euro is the second. Although the immediate dangers have now significantly diminished, they've not altogether gone away. The US is showing signs of a strong recovery, with modest growth of 1.9% predicted for 2013, rising to 3% for 2014. Emerging markets in the developing countries are looking stronger, with growth of 5.3 and 5.7% predicted for 2013 and 2014. The euro area is still being held back by the obvious problems in the peripheral countries, but also concerns at the core are leading to a negative growth prediction of 0.3% for 2013 and only 1.1% for 2014. The UK itself narrowly missed a triple-dip recession, with faster growth than expected during the first 3 months of 2013 at 0.3% rather than the 0.1% predicted. As we've said before, growth is stifled by debt. Lack of exports leads to falling revenues, especially tax revenues, and where imports exceed exports, debt cannot be reduced until this trading gap is closed. A problem in the UK is its weakness of exports, and where over 40% is to Eurozone countries, is therefore reliant on a Eurozone recovery. So there is good news coming from the United States, but the Eurozone is still clearly struggling. If Europe continues to do badly, it will have a worldwide impact, because obviously the world is largely interconnected now. The countries on the periphery need to continue with their fiscal and structural reforms to help jumpstart growth again in these areas, although due to default risks, the cost of borrowing is high in these countries. Italy's prospects are, however, improving as it follows its programme, and although growth is weak, by 2014 its prospects should be significantly better. In the emerging markets of the advanced countries, predictions for growth in 2013 in these areas have actually risen from 2012, but are now at a slower rate of 8% for China, 5.7% India, and 3% for Brazil. The demographics of China and the likely impact of the one-child policy on the Chinese economy is now fairly well known. However, new research on India is exploring the impact on the reducing number of births there as well during the next 20 years. So we could see rising costs for consumers in the developed countries as labour costs rise. After many years of deflation, Japan is seeing fiscal stimulus from QE and structural reforms from its new government boosting growth in the short term. There is still a high level of public debt, and investors may require a risk premium to reward them. However, sustaining the borrowing costs at these levels may be difficult in the longer term. In last month's review, we informed you of an arrangement that can help mitigate inheritance tax. This is a life assurance contract that utilises a double trust arrangement. It sounds very complicated. In reality, it's not. You may invest up to the current nil rate band for inheritance tax of £325,000 into the arrangement, but in order to gain the maximum benefit, you have to survive 7 years. After 7 years has passed, you can start the whole process over again. The money is out of your estate. Briefly, how it works. A number of separate life assurance policies are set up in the investor's name as the applicant and life assured, and legal ownership is assigned into a trust called the initial trust. The rights of the policies are transferred into a settlement trust. The beneficiaries to the trust are also lives assured, enabling the policy to continue if required following your death, providing them with flexibility regarding the surrender of the policy, depending upon market conditions prevailing at that time. The life assurance policies owned by the trust mature annually, allowing the trustee of the settlement the option of either distributing the maturity proceeds or deferring the maturities for another 10 years. This flexibility allows the trustees to pay out money on the policy anniversary if needed, so giving you the flexibility of access to the capital should you require it. While you're still alive, however, you would be taxed at your highest rate of income tax on any growth in the matured policy. in excess of the initial premium distributed because you are what is known as the settler of the trust. The maths that we've run on this taxation issue suggests that the tax would be very insignificant versus the significant inheritance tax saving. If you'd like to discuss this arrangement in more detail and how it may help you in planning your estate to mitigate inheritance tax, then please do contact us. Some of you may have noticed a burst of activity in stock markets during April, and we wanted to just demonstrate here how news can have a dramatic effect on markets. There was recently a fake tweet on Twitter stating that there had been explosions at the White House and that Barack Obama had been injured, resulting in an immediate drop in stock prices, wiping over $200 billion from the S&P 500 in a 2-minute selling spree. After reassurance from the White House, markets immediately recovered and in fact ended up over that day's trading. The impact of traders employing algorithms that automatically buy or sell shares after scanning news feeds are shown on the next page. This is a timely reminder that sometimes noise in the news can affect markets without real foundation, and investors should always be wary about knee-jerk reactions. This graph, which we've taken from the Wall Street Journal, shows the incredible 10-minute burst of activity following the fake tweet. In this month's graph, we've shown a selection of worldwide markets and put through the middle of them the performance of our average risk-rated portfolio. As you can see, we've managed to obtain a positive return over the month with much less volatility at much lower risk, because we would risk rate individual markets on their own as almost twice as risky as a blended and balanced investment portfolio. So in summary, although we monitor the markets daily, we continue to believe that any adjustments to portfolio composition are only recommended following a broad review of the economy in conjunction with the investor's appetite for investment risk. That brings this review to an end, and as always, you're welcome to contact us with any immediate concern, and our contact details follow on the last page. Thank you for listening.